Mark Mahaney is head of internet research at Evercore ISI. Mark, obviously the chips are setting the tone here. So against that backdrop, a deal with Taiwan to produce more of that and try to do it more so here tells you there's more and more capex going into the space. And that's been lifting the trade. So does anything stop that narrative?
I don't think anything does, at least not in the next year or two. Since I cover the companies that are spending 300 to 400 billion now on capex, a lot of that driven by AI. I think the demand for these companies to continue to invest. This is not going to be the peak investment year in AI and AI capex. This is not going to be. It's going to continue to rise next year. Maybe at a more moderate pace, but it's going to continue to rise because I think these companies, quite rightly, are seeing very good ROIs or ROAIs on their spend. So, yeah, this is all feeding the narrative that we're in a capex cycle. We're in a new industrial tech cycle. It's called AI. And I think there's a lot of companies, increasing number of companies that are going to benefit from that.
Yeah. So what is your playbook then? Is it there are a few names in kind of the Mag 7 trade that didn't have as good of a 2025. Amazon, for instance, comes to mind. So let's not confuse kind of the semis or even the AI trade with where we might see those gains being distributed right now. And what's your guess on that?
Yeah. So, look, my top pick at the beginning of last year was Uber. Then I switched to Google. So I made plenty of bad calls, but I got those two calls right. And my top pick right now is Amazon, in part because there's a little bit of reversion to the mean. It was the worst performing Mag 7 last year. I think valuation's very reasonable. But I love the setup on Amazon right here, right now. I think you're going to have accelerating AWS growth as we go through the year. I think there's just a sector-wide, industry-wide, economy-wide interest in investing in cloud services, AI-enabled cloud services, and AWS is one of the biggest wins off that. And then you've got this retail segment that I think is going to actually surprise people with accelerating growth. There's the big, beautiful, bill benefits that'll help all retail, including Amazon. You've got faster delivery. You've got Rufus. So you got agentic commerce functionality. It's making online retail better, and Amazon's one of the best examples of that. And I love this kind of fresh produce, this perishable checkout offering that they have. And with retail accelerating, so will advertising. So you got an accelerating story. You're going to have a prime price increase coming up probably in the next month.
Oh boy.
All of that's going to flow to the bottom line too. Margins are going up too. I love Amazon right here.
All right. Well, let me just ask then a larger question. As I think about what we just heard from the Commerce Secretary and some of the news flow, we just heard the Kansas City Fed president, who's not a voting member right now and always hawkish, but say that they don't think rates should be lowered this year. But JP Morgan has also said that. Traditionally, when we talk about a looser Fed, we're talking about tech being at the forefront, rates coming down, your sector's right in the leadership. What if we're not talking about that anymore?
Well, you're taking me now a little bit out of my power alley, but I'm going to give you a few thoughts. Look, I'm just reacting to the recent news. Love it as an average citizen. Love it when tariffs come down. More manufacturing in this country is a good thing, and there's going to be more manufacturing around the globe to support this AI boom. If more of that occurs cost efficiently in the U.S., I think that's great. And then in terms of
but on the Fed front, I think my question is, traditionally a looser Fed, you often see. Which, they're lowering rates. That's been underpinning the whole rally, but especially tech stocks, right?
Yes.
If we now are talking about a Fed on the margin that, we have JP Morgan saying they might hike rates next year. We're starting to say, is inflation staying a little too sticky? Is GDP a little too strong? Is that a threat for what otherwise seems to be a sector with, plenty of tailwinds?
So sorry. Now I get your question, Kelly. Absolutely, it is. I don't know that that's going to play out, but that's a growflation scenario that you're rolling out there. I just trademarked that term.
I like that.
That would be, if the growth in this year and the stimulus, and I think we lived through this lesson 2 years ago. If we're going to stimulate our way out and we're going to have inflation again, the thing that cracked the tech market back in the first half of 22 was interest rates going from 0 to 100 when they jacked up, and what started a 3.5-year bull market in tech stocks and in the market was started in the middle of 22 was when interest rates stopped going up and started fading down. My assumption is that they continue to fade down, and that's why I think it's a constructive backdrop for tech stocks. But look, if interest rates go the other way, yeah, it'll be negative for all growth assets out there. No question about it.